we have possibly the most important catalyst so far of 2022 coming out tomorrow for SoFi stock as well as the broad markets, and we could potentially be looking at a flash crash or a flash rally coming tomorrow. So we have a lot to talk about. A lot of news came out today. We're going to give you guys the scoop. What is going to make us rally potentially? What is potentially going to make the markets go through a flash crash like scenario? We got a lot to talk about, and you are just in time because it's that time for a SoFi stock update. So as you guys already know, hit the like button, subscribe to the channel, and get yourself those free stocks down below in the description. With Moomoo, you will get 3 free stocks as well as an additional free share of NEO if you deposit $1 to fund your portfolio. So check that out if you guys have not already. If you want to support the channel, that is your way to do that. And let's get this channel to 1,000 subscribers. Thank you guys for tuning in here every single day. I hope it serves you well, and I hope you do make some money. Nonetheless, let's talk about exactly what happened for the day. SoFi stock was down 6.65%, here and after hours up 0.22%. So not a great day. Not a great day at all. Down 65 cents. Not good. Not good. But what actually happened? What caused this move down? Because it does us no good to look at the stock and say, hey, we're down 6.65%. That's it. That's it. We're going down. We're falling through the floor. That doesn't make any sense. Let's take a look at what happened. So Fed Dally said the Fed could start balance sheet reduction as early as May. She is the second Fed member to say this. Fed Williams said on Saturday that they could start reducing the balance sheet by May, and that they likely would, and that the Fed would likely bring the federal funds rate up to about 4% by the end of the year. So implying faster rate hikes as well as reducing the balance sheet a lot sooner than we initially expected. Fed Dally reiterated the same thing today, but what is even more important than that is Fed Lael Brainard. She's the San Francisco Fed president, and she basically said that they're committed to fighting inflation through higher interest rates. It is of paramount importance to get inflation down, Brainard said. Raising rates is what is necessary to ensure that you go to bed at night, not worrying about whether prices will be higher, considerably higher tomorrow, Dally added. And she said that they need to do substantial tightening, that they need to reduce the balance sheet starting in May in a very substantial way. And that's what the markets care about, is what's the balance sheet going to do? What's the balance sheet going to look like? And these were her exact comments. So it says, Brainard's voice carries a little extra heft in that she has been nominated to be vice chair of the FOMC, a position that makes her the top lieutenant for Chairman Jerome Powell. Brainard said she expects the Fed's $9 trillion balance sheet to shrink considerably more rapidly than was the case during the last rundown in 2017-2019. In that episode, the Fed allowed $50 billion a month in proceeds from maturing bonds to roll off while reinvesting the rest. Her comments opened the door to what many economists expect to be a monthly roll-off of around $80 billion to $100 billion. Reducing the balance sheet, quote, will contribute to monetary policy tightening over and above the expected increases in the policy rate. So what does that mean in English? Well, shit's going to hit the fan. Rates are about to go crazy. They're going to start reducing their balance sheet. Now, why do I say that? What is balance sheet reduction? Let's take a look at the Fed's actual balance sheet numbers, because that'll do us a lot of good. So since 2007, 2008, the Fed's balance sheet was about $800 billion. Now it's $9 trillion. Well, we have never reduced the balance sheet in a substantial way besides this period right here, which really started in 2017, but really in the middle of 2018. By beginning of 2019, the markets went down about 25%. They did not like that. Rates were going through the roof. And that's the only history we have to look at. Balance sheet was reduced about $700 billion. The markets fell 25%. Not good. But what is actually happening behind the surface? When you say reduce the balance sheet, why do investors care about that so much? So essentially, what the Fed does is really control the short end of the curve. So they buy a lot of 3-month bonds. They buy a lot of 2-year bonds. Well, a lot of those bonds are coming to maturity. 2 years ago, think back, that was April of 2020. They were buying a lot of bonds during this time. This is this whole increase. You see basically this whole jump and this steady increase right here, right? This is the last basically 2 years. Now, when the Fed owns these assets, these treasury bonds, they help keep rates low, like your treasury rates, right? Are you guys following me? Keep those low so it's easy for us to borrow money, easy for businesses to get loans because the rate's low. So think about it like this. If the Fed was giving you or offering you 2% to invest your money in treasury bonds, and then you were trying to get money at 2%, who would you give money to? You would give money to the government because you're more likely to get your money paid back to you than if you lended me or somebody else that is watching this video that same money for 2%. So you charge a little bit more premium than that. Well, what happens when the Fed starts to sell bonds? They start to drive the price of bonds down because supply and demand, you're selling more bonds, and the Fed, trillions of dollars, they are the bond market. Pretty much. They're a vast majority of the bond market. So they start to sell bonds. It causes prices of bonds to go down. Whereas like a dividend stock, best way to imagine this, a dividend yield is fixed. So maybe you get 25 cents a quarter. You get $1 per year. The stock's trading at $100. That's a 1% dividend, right? Pretty straightforward. If the stock falls to $50, you now just doubled your dividend yield if you keep buying the stock. Now, same thing. People were selling that dividend stock, caused the price to go down. Yield goes up. Same thing with the bonds. Fed starts to sell, price goes down, yields go up. Now, take into consideration that analogy I just gave you guys. If now the interest rate is 4% that you could get through the government, now you want to lend money or I want to borrow money from you, you're going to charge 5 or 6 or 7%. And those are astronomically high rates. And that's the trajectory that we are heading towards. So it really slows down the economic activity like car loans, home loans, even margin debt, right? Companies that need to raise capital to grow, it really starts to hurt them. And that's more significant than actually raising rates 9 or 10 times in a year. It causes a lot more tightening to actually happen because raising rates, raising the federal funds rate, that is only the rate between the banks lending each other money. That's what they have to pay each other to lend money amongst themselves. It's not really directly related to what you have to pay when you go get a car loan or a home loan or a business goes to get a loan. It's based off of treasury bonds because they are competing assets. So hopefully that made some sense. Hopefully that, I broke it down enough. This is a complicated topic. It takes years for people to fully understand this. So if you don't get it, just go back and rewind a couple times if you have to, so you're fully aware of what this means. Now for tomorrow, what does this mean for tomorrow? You get the FOMC minutes that come out at 2 p.m. So later on in the day, you're only going to have about 2 hours left of trading. But the markets were not expecting the Fed to start reducing their balance sheet in May. They were expecting June, July, August, September, somewhere in that time frame. And from the Fed's implications today and what they said, it sounds like they're going to be reducing the balance sheet at a much faster pace. So you could expect $100-200 billion of assets being sold per month, and that's going to drive rates up through the roof. Now, when I say you can expect that, that's kind of what I'm expecting. The markets are not expecting that. The markets are not expecting that. If you get a higher amount, if the Fed's talking about reducing the balance sheet by a couple $100 billion a month, or even, on the upper end range, 150 billion a month, you're going to see the markets drop substantially because we were not expecting it. Kind of like a black swan event, more like a gray swan event because we knew it was happening, but we didn't know it was going to happen so soon or so aggressively. That's only my opinion. We don't know exactly what is going to come out, but that's what it sounds like from the 3 Fed speakers that we have heard from so far. That's my take on the bearish case. And if that happens, if we get totally rug pulled and surprised, the markets could fall 4 or 5%. Very, very possible. Look what happened during the last balance sheet reduction. And that was only $700 billion. You're talking about reducing the balance sheet by trillions of dollars. It's not going to be good for the stock market. That's, I think, the most likely scenario is the markets are going to fall dramatically. The markets are not going to like what comes out during those Fed minutes. But at the same time, if nothing comes out from the Fed minutes and it was just the Fed speakers just saying this and that and giving their own opinions there, which sounds more like a correlated thing. You had Fed Williams came out on Saturday, Fed Daly and Fed Brainerd came out and all saying the same exact thing. Sounds pretty coordinated. But if nothing comes out during the Fed minutes, then you're actually going to see the markets rally, because the markets are now expecting balance sheet reduction. They're expecting, in between $80-100 billion of assets being taken off the balance sheet per month. If we don't get that, you're going to see a flash rally. If we get that or more, you're going to see a flash crash. So that's really what you guys need to know. You're also going to get some glimpses into what they expect to do as far as interest rates. The bear case here, maybe instead of raising rates 0.25%, they're just going to go, hey, we're just going to raise rates 0.5% every single time. Maybe 5, 6, 7, 8 times this year. Markets are probably not going to like that either, but the markets are really, really sensitive to the balance sheet. And how does this affect SoFi? Like we just talked about, it makes the rates to borrow money, like me and you, to borrow money, buy cars, buy houses, start a business, all of that makes it more expensive. So who does SoFi appeal to? They appeal to a lot of customers like me or you. So in theory, big air quotes here, in theory, it should hurt demand for SoFi lending products. Does that have to be the case? Absolutely not. SoFi might do very, very well. Well, I think they will do very, very well. But even if rates get super aggressive, super quick, SoFi stock can still do very well. SoFi's business can still do very, very well. There's a big total addressable market there. They're branched out into many different segments. It's not all just lending. So that's definitely a positive during this time. But investors, they're probably going to look at that like, hey, and start to imply, like I am a lot in this video, that SoFi's not going to have as great numbers. So you might see downgrades come out. You might see, people not saying some great things about the lending space. And that could hurt SoFi stock in the short term. But I want you guys to remember, insiders are buying this stock. They are in one of the largest growing segments in the world. Fintech, digital finance, lending, investing. They're in all of that. They're in a lot. So, SoFi's business is going to do just fine over the next coming years. The lower the price goes, the less risky it actually is to buy SoFi stock. People think it's the opposite. When SoFi stock is ripping, people are like, hey, it's not as risky. It's going to the moon. That's great. It's more risky the higher the stock goes when you're thinking about adding to your position or starting a new position. So I will be faithfully buying the dip, selling a kidney if I have to buy as many shares of SoFi stock as possible. If we do really fall to like 8, 7, 6, 5, it's going to be great. I'm going to love it. I'm going to go refinance all my rental properties. We're going to kill it. But nonetheless, that's really the good and the bad that could come out of tomorrow. Not a fortune teller here. What it sounds like it's going to be bad. And the fact the markets were only down about 26% on the S&P, it doesn't look like all of that potential bearishness is fully priced into the market. So I hate to be the bearer of bad news, but I gotta be if it affects your money. And ways that you could trade this as well, if you're interested in trading options or anything like that. Obviously, I don't necessarily endorse that for everyone, because a lot of options expire worthless, and if you don't know what you're doing, you're probably going to lose money. I do have Apple puts. Not going to go over specifics here, but they are a couple weeks out. I do have Apple puts. They did well today, so I wouldn't necessarily buy those. But I would probably, if I didn't have a position now, because you're going to see a big move after 2 p.m., and it'll likely continue on Thursday as well, I would probably wait until after the report comes out to see how the markets move, see what kind of mood you're getting from the report. You'll know right away if it's very, very bad or if it's good. You'll know right away. The markets are going to move big. So that's really my take on it. A lot of opportunity there, but not a recommendation. Do not buy, sell, or trade anything because you hear a YouTube video or any of that. If you trade options, you will lose money, maybe all of your money. You really never do know. Now, as far as on Thursday, you do have more Fed speakers that speak. You have, hold on, I think it's Fed Williams, Fed Bostic, let's see exactly. Fed Bostic, Fed Evans, Fed Bullard, and Fed Williams. Yes, you have 4 Fed speakers the next day after that, and that could really hammer down a lot of that hawkishness that we get tomorrow, or it could be good. It's really 50-50, but I think it's more like 70-30 at this point. 70% chance it's going to be bad, 30% it's going to be good. If it's bad, it's going to be really bad. If it's good, it's going to be really, really good. Now, let's get into SoFi specific data. I know this video is going to be a little bit on the longer side, but I really wanted to go over and explain how the balance sheet reduction affects the markets so much, because it's not really something everybody is going to grasp. And if you can grasp that, you're going to make a lot of money, especially if you're a trader. If you can see these things coming throughout, from today until the end of your investment journey, you're always going to be able to trade the Fed and make a lot of money off of that if you can understand them. Not anybody and everybody can understand the Fed. Now, as far as SoFi, the short interest of free float is 16.8%. Current shares that are sold short, 121 million. Cost to borrow max of 3.14%. And you are seeing utilization of 100% and days cover at 2.82. As far as option activity, about 11 orders for the day, $2.73 million worth, positive order value of 38%. Now, I also want to point out, if SoFi stock does fall a lot, you'll probably see a lot of support from the insiders that go ahead and buy SoFi stock. So that also could, I'm not going to forecast how much or when they're going to buy or any of that. But from what we've seen, stock goes lower, insiders likely to continue to keep buying the stock. So that should provide a little bit more stability. I really don't think you're going back to, or not back, we've never been there, but going down to $5, $6, $7. I don't think that's the case, but it is possible if the markets do have a full-on meltdown panic mode. So something to, keep your eyes on. As far as SoFi stock and the max pain, let's go ahead and pull this up. Let's pull this up. So we got, for this Friday, $9.50 per share, and we're currently sitting at $9.14 per share. So not too far off that. That would imply a move to the upside. And if we do see a bad day tomorrow, bad day on Thursday, you'll likely see a bounce on Friday. I don't think it's going to be a huge continuation. I think it's just going to be a sharp move down or a sharp move back up. The SPY definitely has a lot of meat on the bone, though. That's what's kind of worrying, to come back down to some of these previous levels. But nonetheless, that's basically all you guys need to know. Not too much news that actually came out from Russia and Ukraine. Nothing positive on that note. We're looking forward to more sanctions tomorrow on Russia as far as energy from the EU, and from America on more luxury goods, I believe steel and a couple other things. We'll wait and see what happens with that. I definitely don't think that's going to be a big driving factor of how the markets are going to move, especially for tomorrow. As far as the Fed rate monitor tool, last thing, and then we'll look at the technicals briefly, and then we will wrap up this video. You're looking at 78.3% chance of a 50 basis point rate hike. That's a 50%, a 0.5% rate hike on May 4th. You do have 4 weeks, 19 hours, and 50 minutes until the next Fed meeting, so we do have a little bit of time left on that. And June 15th, you do have another 78.3% chance of getting another 50 basis point rate hike as well. So the markets are expecting that, but you never know how much is actually priced in to the markets. But as far as SoFi and the actual technical outlook that we are looking at right here, we've got rejected off $10 so many times, I'm starting to lose count. So if we do see a big positive day tomorrow, which is very possible, I don't want to just sound all negative here, it's very possible we could see a big green day as well, then you will break straight out above $10 per share. If we see a bad day, I would likely expect the stock to trade down to about $8 per share, maybe $8.50, somewhere in that range would definitely not be uncommon or not be too crazy to see, given what the catalyst potentially is going to be. As far as the volume, that is 46 million for the day, 46.8 million. So definitely a lot more activity on SoFi stock today, but we're still not even close to where we were just at as far as volume over the last couple of months. But still, we're waiting for the volume. Once it comes back into the stock, once the Fed changes directions, U-turns, or we just get another positive catalyst for SoFi stock, that's when you're going to see the next move to the upside. Now, the MACD is still bullish, but it is starting to come down, starting to diverge, and you are seeing, and go bearish, and you are seeing the RSI at 43.84, which is under neutral at 50, so you're starting to get on the oversold side there. So that is going to be all for this video. like I said, if we do fall dramatically, I will be loading up on SoFi stock. If we rip, then I probably won't do all too much. This is really one I'm not going to freak out and panic and buy the, buy any small dip. If we're going to dip a lot, then I'm going to go big on these buys. If we rip up, I'm not going to FOMO into it. So I already have a very large position. Nonetheless, thank you guys for watching. If you guys found any value out of this video, if you learned something, hit the like button and subscribe to the channel. Get your free stocks with Moo. Like I said, sign up, deposit $1, get 3 free stocks as well as an additional free share of NEO. It's virtually free money. Not even a sundae at McDonald's. They used to be like my favorite thing ever when I was a kid. Hot chocolate fudge sundae. Not even $1 anymore. It's kind of sad. Nonetheless, you guys enjoy the rest of your day, and I will see you in the next one.